Hi, this is another investor video on Armadale Capital following news on Friday of their further MOU and them hosting an investor webinar at lunchtime, of which I'll cover a few points in this short video. If you want to know more about the company, it's progressing its Mahenjali graphite project in Tanzania. It's high grade, high purity project. And I put together a video on that a while back covering the company, graphite market and the investment case as I see it. And I've also produced some other videos, snap videos since, covering recent news flow, things like the resource upgrade, other MOUs and related news. So in this video, I really just want to touch upon a few things like, how I see the company progressing and the potential opportunity to new investors. I hold a position in the company. I've been buying some stock recently as well, just over 2p. I'm liking how the story is progressing, how the project's being de-risked, and therefore, I'm happy with the investment. So, Armadale Capital currently capped at 9 million, probably just over that today as I speak. And one of the things I've been asking myself and a few other investors talking about is why it's got such a low market cap in comparison to ASX peers that are also running similar projects in Tanzania. And this was touched upon in the webinar on Friday as well. And I think we can probably put this down to a few things. Brexit obviously is affecting UK market sentiment. There's no getting away from that. And I think we've seen that across other companies as well. So that's one thing that I think has probably been holding the price back. I also think that the company's got some legacy management and issues, which the board is now a new, fresh board, and the project now is very much focused on the graphite project, not the old gold project. So the company are in a completely different place, but mud does stick sometimes. So I think from my perspective, I'm now happy with this. Is in terms of it's a new company for me. I think the Australian market sees more value than the UK market does in the sort of Tanzanian graphite mining projects. I'm not quite sure why, but I just think it's maybe something the UK market hasn't seen yet. But I think the story is starting to get out now. We've seen an increase in volumes. The share price is moving up nicely. It's starting to hit a new technical level and potentially break out. So from that perspective, I think the the story is getting out there now. So recent significant news then. So the company have been busy. They've delivered a lot of news over the last couple of months. They've actually put together now 3 offtake MOUs, and that's for 120% of the annual production as specified in the scoping study. So 120%, that sounds high, and it is. And I think the reason is that obviously the offtake partners want that level of, if you like, product from Armadale going down, down the road, and they can facilitate this by an increase in their annual tonnage. And this can be done because the recent resource update showed high-grade zones, which mean over years 1 to 8, they will be able to increase the tonnage up to 60 or 70,000 tonnes per annum, which I'll discuss a little bit later on as well. Also in the resource upgrade, they converted 11.5 million tonnes to the measured category. This is a very important de-risking step for the project and having financing discussions, because it's massively increased the confidence in the resource, and they updated the indicated category as well. So this was something I think the market missed. Perhaps the market's not that interested in resource updates, but for me, it was a big de-risking step. They've now got 3.1 million tonnes at 15% target graphite content, including 1.2 million tonnes at 17.5%. So in total, 3.1 million over 8 years at the 400,000 planned processing is a nice 8-year mine life, and as I said, will increase the tonnage. And the project itself has increased its overall tonnage now up to 59.5 million tonnes. So this is going to be a significant mine life increase. I think, as with all mining stocks, I don't necessarily do this in a lot of my videos. I think I should do more of it, but I think we need to keep an eye on risk. It's always worth pointing out risk. I look at risk very, very carefully. And I've just highlighted 3 here that I think are risks that I'm going to be aware of and looking at. Graphite pricing, there's a lack of transparency in the graphite pricing market. A lot of these a lot of the pricing is based on contracts. It's basket price product as well, so it depends on the flake size and purity distribution. So it's something to keep an eye on, but we can get confidence and risk mitigate this by the fact that a number of the other ASX companies trading in the Australian market have actually struck binding offtakes now, which locks in pricing. And also Armadale have the higher purity product up to 97%, so this should command higher prices. Capital financing is another big risk that all mining companies face. You know, they've got to get it over the line to actually progress the project. So for me, this is one that I take very seriously. However, ACP has an extremely low capex cost of 35 million, which is a 1:10 ratio to its NPV of 350 million, which we believe is set to is going to improve in the DFS given the recent purities and resource increase and grades. I think that also lenders that would be looking to potentially lend to the company would like the fact that it's actually a 1.2 year payback, and in fact the company could probably, from cash flows, pay that capital back excuse me, within a year if they wanted to. And what we see now is Walkabout Resources on the ASX, a peer of Armadale's, are actually just launched a 40 million debt financing process after the lead bank that's helping them do it has done the due diligence on the project. So this is also further risk mitigation. And then I think lastly, the mining regime and licensing. So ACP will require permits and licenses to proceed. The Tanzania mining regime was overhauled in the last couple of years, and companies like BlackRock and Walkabout have actually been awarded their mining licenses. So I see that as further risk mitigation there too. The re-rating potential then. So I put this chart together a little while ago, and what it does is it actually shows how Walkabout they're going to be running a similar project. I think slightly higher capex, but it's very comparable. It's a good example to use. And you can see here that Armadale, the red circle, we're currently sitting around about 10 million market cap, which is half of where Walkabout was sitting at 20 million market cap equivalent before they started announcing their binding offtakes and completing their DFS. So one could, surmise that Armadale, if they complete the same steps and all the progress to date has been good, that they could follow a similar re-rating journey. And you can see on that chart there the various pinch points that have started to cause the re-rate. And it's worth noting that at its peak, Walkabout hit 80 million market cap, which would be an equivalent ACP share price of around about 18 pence per share if we were to achieve the same re-rating potential. So that's an interesting example there, and I like to be able to benchmark investments to other companies. It validates the investment strategy. So key news flow to come. The news flow has been coming thick and fast over the last few months. This is what's probably brought it a bit more visibility onto the market now. We can expect to see news on the permitting and mining license, product testing. So they hired a company called Battery Limits to test their graphite concentrate product and actually put it to real end use in things like batteries or expandables. And really, this will sort of feed into binding offtakes as well. Conversion of MOUs to binding offtakes expected for the year end, as per the conference call on Friday, which is a big de-risking step for me, and again validates the product and how good this project is. We'll have other DFS updates coming as well, and the DFS completion itself at the end of 2019. So I'd expect to see probably the DFS published early in the new year, because they'll probably need to go through some sort of auditing of the report and validation of the inputs and what have you. So that's due for completion. And then we'll be moving on to project financing. And as I said earlier, Walkabout have just launched a 40 million debt raise. So I think with Armadale having 35 million capex figure, this gives me some confidence, especially in terms of the overall economics, the relative amount of capex that they need to raise. And then we should see possibly some further board appointments as the company starts transitioning into going from developer to producer. They'll want to probably bolster the board, and they have touched on this in the call on Friday. So lastly, I just wanted to do a quick scenario because I wanted to sit down and actually start looking at some of the cash flows, some of the inputs, some of the assumptions, and start figuring out what the company could do in terms of return. Obviously, investors will look at share price appreciation, which is a very important thing. We've obviously already established that ASX peers are trading at multiples. So therefore, there is room for Armadale to increase its share price significantly from where it is today. But if you take a longer term investor perspective as well, you can actually start looking at, well, what will this company be returning me in terms of, a dividend, for example. So what I've done here is put a basic example together. The company could be producing as early as Q1 2021, as there's only around about a 10-month timeline from start of construction to start producing. And if you think that they could secure the project financing early in the new year, 2020, then within 12 months they could be producing. So that's interesting. And if they were doing that, what sort of cash flows would we be looking at? So obviously I'll have to caveat this with some of this information I've got here is based on research, and some of the numbers come from the scoping study. So you see there's a 35 million capex. I've used a $1,300 a tonne basket price, which is conservative for high purity graphite. An estimated all-in cost of 450, margin 850, and then I've got a government tax estimate of anywhere between 20 and 40%. Mining companies always have to pay government tax and royalties and what have you. So I'm going to use a 30% tax basis for this calculation. And then I'm going to work on the basis there's 500 million shares in issue. There's around 400 million today, but fully diluted, I believe, with warrants, it will be around about 500 million. So if I quickly go through the numbers, I'm focusing on an 8-year mine life because this is really the high-grade resource that they'll mine first. I mean, the mine life itself will be 50 years plus based on the recent resource upgrade, and post year 8, they could be looking at maybe mining about a 9% product. But on the 1 to 8, it's quite compelling economics. So we've got 1.2 million tonnes at 17.5%, based on 400,000 tonnes per annum throughput. That would be a 3-year mine life at 70,000 tonnes per annum. And then we've got a further 1.9 million tonnes at 15%. Again, same throughput. That'd be a 5-year mine life at 60,000 tonnes per annum. So if we look at EBITDA over those years, so year 1 to 3, we're looking at 70,000 tonnes per annum times 850 margin equals $59.5 million. Take off government tax estimate, 30%, that would leave us 41.5 million. And then years 3 to 8, slightly reduced tonnage, 60,000, 850, 51 million per annum. So I've just put a scenario together here. This is what the company are necessarily going to do, but it's just an idea that I have in my mind. You can work various different scenarios, but I've just gone, right, okay, they're going to pay the capital back over 3 years. I mean, they could do it potentially in under 1 year, but why not bolster the balance sheet and use that capital, redeploy that capital into growing the business further? So year 1 to 3, they pay back 30 million per annum. So they're left with, based on the years 1 to 3 cash flows, 28.5 million on the balance sheet. This will bolster the balance sheet, and they could use this to potentially expand the plant so they can increase throughput, so that when they're processing lower grade ore, they can retain EBITDA. And then year 4 to 8, the capex is now fully repaid. They've funded the plant expansion, and they could look to pay a dividend if they wanted to. So if we say they'll allocate 50% of their 36 million in years 3 to 8, that's 18 million. Divide that by 500 million shares in issue, that's 3.5 pence per share dividend. That's significant if you think you can buy 1 million shares today for about £25,000. That 1 million shares would be paying you a dividend potentially in 2022 of £35,000. That's not a bad investment, is it? Now, obviously, there's other things to factor in, G&A, and there are still moving parts to this. We don't know whether the government would take some stake in the project as well. I've assumed 0% here at the moment. We're waiting, I think, to hear from, see what happens with BlackRock mining. So there's a lot of moving parts, but this is just a scenario, and this is what I wanted to do: sit down and actually start looking at some of the figures. But you can't really ignore the the EBITDA figures that are massive for a £9-10 million market cap company today.
that is potentially so close to producing. So I hope you found that video useful. By all means, give me some feedback, and look at any of the other videos on my channel relating to recent news flow.